So who wins from dollar strength and oil price volatility? Well, notable in the market this quarter was a powerful rally in the dollar, as well as a grinding recovery in the oil price. In our view, there are some definite winners here, and there are some losers too. One immediate winner is the U.S. consumer, which typically benefits from a lower fuel price. That should help the consumer in a couple of ways. The prices on shelves fall from lower transport costs, and the cost of driving around drops. That last one is meaningful. Americans drove 4 million miles in December. Lower costs generally mean more spending power, and there's evidence that U.S. consumers are spending. And that spending is leading to more hiring. One measure suggests that U.S. companies have 5 million job openings currently. The expression "designed in California, manufactured in China" has a certain ring to it because of another winner, the Asian exporter. In 2014, exports made a minimal contribution to Chinese growth. But with exports contributing to growth, the Chinese government's move to loosen financial conditions means to us that the economy should show positive performance, and that's good for the Asian consumer. Dollar strength should help commodity producers with local currency cost bases. In emerging markets, that's everyone from Indonesian coal miners to Russian phosphate miners to South African gold miners. But not everybody wins in this area because oil price volatility hurts the outlook for drillers and the oil companies that they service. It has benefits in the Middle East too. More volatile oil prices can reduce further the discounted oil sold by non-sovereign operators, and that means less cash to spend on security disruption. Lower oil prices hurt economies with less diverse export bases, whether that's in Venezuela or in Saudi Arabia. The difference being reserves. Official Saudi reserves at the IMF are $718 billion before gold, while Venezuela boasts $2.3 billion. But dollar strength really means one thing to us. It means weak local currencies. And weak local currencies mean that local economies are getting more competitive. If you live in America, this is a great year to take that amazing vacation to the emerging world. Local central banks have been easing rates, so this feature might be with us for a while. Dollar strength typically can create another loser, over-leveraged companies with local currency revenues. So far, 2015 has been a year where downgrades have seen a lot of headlines. We've had $74 billion in hard currency bonds downgraded this year. So what do we think? Where does this all go? Well, with U.S. rates low, the market remains supportive for spread products despite the downgrades. And spreads have widened out on uncertainty, which is an interesting outcome. Volatility is low against historic averages, which should help carry traders and those that are carrying leverage positions. But with the U.S. market heating up, the Federal Reserve probably has the evidence it needs to start hiking rates, and that will likely increase volatility. So to us, volatility going up means a market that supports security selection as a source of performance. So houses that have invested in research capability are probably well placed. If rates rise, that probably supports those that have maintained a short duration bias of their portfolios, which sometimes means resisting apparently interesting valuations at the longer end of the curve, for better or for worse. Above all, the winners in this situation are those who retain the flexibility to take advantage of these situations.